Hey everyone, this is Addy again. So my idea today is to take everyone through a credit spread in either a futures options or not index options but futures options or any equity options, just to show you how to actually set this up, trade this trade these two-legged option spread, how to manage it, and how to and when to take profits. So the idea is like within the next 5 6 minutes, because that's how long I think the video. I want to keep the video short because that's how I work too. I don't want anything longer than 5 or 6 minutes because then I lose interest. So I want to keep it short for you all as well, and just want to take you through how I trade and how I would set this thing up, just to like give you a taste of how to get started with this. My full-fledged website, my full-fledged other courses are coming up soon. I'm building them. I'm developing them right now. I'm quite busy with my day job as well. Um, but yeah, the idea is like just to take you guys through everything. So first of all, I have this is my simulated trading account in TD. I'm using this so that we now the markets are closed. It's August 7th right now, 3 p.m. Pacific. Markets are closed. I'm trying to make this video to like take you guys through what is it that I'm looking for. This is the ES chart. Now this is futures contracts on the SPX options. SPX is obviously everyone knows is the index, the main 500 company index in the US. These are the futures of that index. Now I'm looking. I normally trade futures options. Now I'll tell you the difference between trading an index option and futures options. We'll do the exact same trade, and then you'll see the difference. First of all, this is futures. I'm looking at the chart. The market has dropped quite a bit from the highs. Let me just grab a marker. Market has dropped quite a bit from the highs. Volatility has ticked up. Here's the volatility chart. This is the implied vol that you can add in your toss screens. I look at this is my main, my main metric. My main metric to see where things are. And this is the open interest chart. Now you can see open interest on average is around 1.5 million contracts here. This is in millions. You can see that 1.5 million, meaning each contract is roughly worth 50 index points. Now an index point is basically I need to take out this thing. So let's say the index is trading at 5200. It's worth 50 index points. So each contract is worth $260,000, and there are 1.5 million of them. That's how much the contracts are worth, all the open interest. Now I'll explain what open interest and volume is. Anyway, market is down. My rationale is I need to go long here because I see juicier premiums on the put side. So I will escape all of this noise on top, and I'll go directly to my 40 to 45 to 50 day to expiration, and I will look at the AM settled expiration. Now let me show you the difference between this 44 DTE, which is week 3, and this 44 DTE, which is AM. Week 3. Sorry, I need to fix the strikes because I don't normally use my simulated trading account. This is just for the video. If you go down here. Again, I need to set this up. I cannot find how to add the deltas here. It's got to be some. Oh, it's here. I see it. Okay, close this. Sorry, that was my bad. I should have set this up before. Well, it shouldn't take too long. Okay, so here we want to change this to delta, gamma, theta, vega. Right now, these are your columns. Now your columns are set, and you also want volume. Actually, let's do volume and open interest first. Let's see what the volume and open interest is. So here we are, open interest, not much, right? You see the volume, not much in all these strikes. Now you go to the AM settled ones, and you will see in thousands. And that's the reason why we trade this expiration versus the other one. You look at this column, it's in thousands. That's what you want because this means liquidity. Now liquidity means you can get in and out of the contract easily. Anyway, time is short. Let's go through it. So I'm going to use this AM settle one. Now let me change this to and actually you can customize it. In my normal account, I have it customized, so I have everything there. So I'm going to go, my sweet spot is 18, 17, 18 deltas, which is 47.50 right now. And I'm going to sell a vertical. Put spread, because I think the market has dropped down quite a bit. So this is how you select the strikes. You go to 17, 18 deltas on each side, on whichever side you want to sell. And then you just right click it, and then you sell vertical. Now I always do not more than 1 or 2 contracts, because these are big contracts. Now here, $3.25 you're collecting. I normally go to the Analyze tab. Here I need to fix this. It just shows that my paper trading account is not set up at all. Okay, risk profile. You need to click risk profile on the top. And from the break-even side, from here, go to set slices, break-even, and select the expiration that you're in. And on top, make sure that this date matches the break-even slices date. Now here you can see that my probability of being in the money is around 81%, and that's what I like. I want 80 or above for my probability of profit to be. Now, how do we read this P&L diagram? The T line is basically your max profit. So you're collecting $3.25. Now remember, in SPX contracts, your max profit is half of this number. So if you're collecting $3.25, your max profit is 1.65, meaning 162.5. And that's what you see. That's how the ES options work. Your max loss is basically 1,000 minus that number, because the whole spread is $1,000. So your max loss is 8,375, which is if you hover over this line, you can see that 837.5. So you're basically going to make $162, and your max loss is 837. Obviously, we never ever go to max loss. There are multiple ways to manage this trade, and I'll show you how. So let's try and put this in, right? You will right click, confirm and send. Look at the buying power effect, only $191. And after commissions, you're going to take home $158. Now it depends how much you actually take home, which is also what we will discuss. But this is a paper trading account, so let's send the trade. And usually you get fills right away, because even though the prices are delayed, it's working right now. So yeah, there's one working order, which is here. You can see that. The mark price has dropped. The mark price has dropped quite a bit. So we will cancel and replace this order, and then just take the market right now. We don't care, because we're just doing it for educational purposes. So we just take it. So there you go. This is the fill. I got filled at 225. So 225 is my fill. It's already there. No P&L right now. Well, negative 25 P&L on the put side, short put, long put, and then the positive 25 on the short put. So how do you manage this trade? That's the key question. So if I select here, now this is my real trade. You have to select your position to show for the chart to come up. How do you, sorry, the time is overrunning right now, but I just want to show you how to manage this. Now, let's say the market goes up on you, fine. That's the direction you want. You will manage it by taking off the spread at 50% of max profit, fine. However, if the market goes down, meaning you collected $225 here, if the market goes down on you, let's say at 100%, that means the amount that you've collected, the credit that you've received, if your net P&L is twice that much, if it's 100% of that, that's when you will start making the adjustment. And the way you make the adjustment is you sell the call side to close out the deltas. Now, let's say the market goes down on us and the put spread is coming in the money. It's coming in the money. You would go on the call side. Let's say the put spread is now trading at 30 deltas, right? You sold it at 70, it's trading at 30. It's a little bit of a loss for you. You would go on the call side and you'll sell a 30 delta call spread to make it into an iron condor. The reason you do that, and this is a $20 wide spread. I always do $20 because there's a reason behind it, which I'll discuss later. And you are collecting $6 on this. Now, I don't know if that's true because the markets are closed, but I'm just going to send this in just to see how the trade looks overall. Now, I got fills that I converted into a iron condor. So this is how it looks now. First line of defense is to convert it into an iron condor and then close out all the deltas. Sit there, wait for it to come back to you, and then see how the theta works for you. The next step will be to move this whole spread out in duration. So you will collect more credit when you go out in time. When you go out in time, I mean, you will go into the next available cycle, which is not this weekly one again. You will try and find the one which says either end of month or AM settled. And the yellow ones are weeklies or, not the traditional end of month ones. These yellow ones, these white ones, or the grayed out ones, are the ones which are, they're backed by one of these futures contracts here. Now each of these cycles, now you will see the change here. Anything above this line, this 44 line, is ESU24, U24, meaning it's backed by this contract, which is the September contract, the top of the line one, which has 44 days to go. All these futures options are basically backed by these futures contracts. So on settlement, you will either get a futures contract or you will settle in cash. All of these settle in cash anyway. SPX contracts settle in cash. Futures contracts settle into the futures. Again, a different story we can discuss later. Anything after this line, you will see is ESZ24, meaning it will then underline the December contract. Now, if you want to see how the futures contracts work, they have a September, December, March, June, and then another September. And then the line goes down and down and down. You can just see the S&P futures are the most active, most liquid, so they have a lot of expirations going on. But the most liquid one, you can see the volume, the amount of volume always trades in the front month, which is the current open contract, which is September, which will expire in 44 days. The next available contract, which is the most liquid, is with 35 contracts volume, which is December. And then the further down you go, you'll see NAs because nobody's trading those. You should see a open interest bar as well here, but we cannot. The open interest bar is open. There it is. Well, that's the open. I'll have to set this up better. But anyway, this is the idea behind it. Sorry, it took over more than 6-7 minutes, which is what my target was. But there's so many things to discuss, like how to manage this trade, what to look for to collect in dollars, how to how to diversify your portfolio with different underlyings, with different indices, with different commodities and interest rates. All of that we can talk about in upcoming videos. My idea is to educate you guys, not to sell you guys. I don't have anything to sell right now. My website is under construction. There's nothing to sell. It is coming along. I don't have anything there yet. There's only one free course on the futures options if you want to check it out. Go sign up. I discuss almost everything in there. And then there's nothing else. The idea is educate you just to make sure that we clear the bottlenecks and get you ready to step into the world of selling options. Now, buying options is a completely different ballgame. I don't do that. It's very low probability. I stay with high probability trades like I showed you here. It's 78% chance of making money. Thank you very much, everyone, and I will see you in the next video. Thank you. Bye bye.